We're going to look at Macy's, and what we're going to do is calculate the intrinsic stock price using prior financial information. So first, let's look at the market cap. It's 2.282 billion. And the stock price, as you can see, it's up 20% today. 741. And now we need the free cash flow. And the best way to calculate the stock price is to estimate the future free cash flows and then discount that number back to today's dollars. Next, we need net income. And we need net income in the discounted cash flow model, but we don't estimate future net income, although a lot of people think we should. But the reason we don't is because on the income statement, they report a lot of non-cash items, and they also use accrual accounting, which makes it really difficult to use that number for valuation purposes. And the last number we need is revenue, which is the total sales per year for Macy's. So now that we have our calculation done, now we need to look at the capital structure of the company to figure out what we have to discount the cash flows by. So first, the income statement, because we need the interest expense. This is the interest they pay on the debt. Now we need to see how much debt they have. So we go to the balance sheet. In the liability section, under current liabilities, they have 533 million of current debt. And then long-term debt, that's debt due beyond 1 year, is 3.6 billion. So they pay 4.91% interest on the debt. But we need to figure out the effective tax rate now because interest payments on debt are tax deductible. So what's the income before tax? And that's 728 million. And now the taxes are 164 million. So they pay 23% in taxes. So even though they had 4.91% interest on the debt, it's actually deducted down to 3.8%. That's the cost of debt. Now the cost of equity, we use a capital asset pricing model to do that. That's a standard model for cost of equity. And we need the beta, that's 1.56. That means stock moves 1.5 times the market. So the cost of equity is generally a lot more than the cost of debt. In this case, it's 14.3% the cost of equity. Because equity sits lower on a capital structure than debt does. Therefore, it's more risky. Like in a bankruptcy situation, the debt holders get paid first before the equity holders. So the WACC, the weighted average cost of capital, is 7.53%. And this is the cost for this company to obtain financing. So if the company is not generating at least 7.53% of profit through its normal operations, then it's not providing value to the investors. And if it continuously generates less than that number, like even if it's positive, but it's 5 or 6%, in the long run, it will go bankrupt. So they have to bring in more than what they borrow at. And now that we have the future cash flows calculated, this is the present value of the cash flows, and the total value of the company, according to the model, is 6.6 billion. And that means out of 308 million shares, the average stock price is $21.40. That's a calculated stock price based off of our cash flow model. And the stock is trading at $7.41. And let me show you the chart for Macy's, the stock price the past few years. So it was definitely trading above intrinsic value, even a few months ago. And it was trading well above 40s, and way back in 2015 it was trading in the 70s. So now it's trading below what it's worth. So sometimes the value of a company doesn't line up with the actual price. The market is saying, I don't think it's worth $21.40. I think it's actually worth $7.41. That's based off of supply and demand of the stock price. So maybe you might feel the same way too. Let me know. Do you feel Macy's is worth $7.41, or do you think it's worth closer to $21.40? Let me know in the comments what you think. Thanks for watching.